the recording of this meeting, as I see only 18 persons here, I suppose other students plan to see the recording. So let's see. What is product margin and why do we calculate it? First of all, there are three basic reasons why the voted product margin for the two costing systems differ from one another. So why do we calculate the product margin and the customer margin? Because we need to know whether our operations related to the particular product or our relationships between our company and our customers are profitable. Because if we would be making lots of discounts, special prices, if we would be undervaluated our costing, so in that case our margin should be recovered using other sources. For example, we can produce the product which is and the product margin is really low. But we should do it with open eyes. We have to understand that we need to cover the cost of these non-profitable products using the most profitable products. So we can produce the full scope of our products and decide whether we can produce something interesting but having low margin in to reimburse, I think, these costs in future. For example, if our product is good enough but our customers are not informed very well about the potential benefits of these products, we may the low margin approach in order to sell this product using lower prices and the spread our products among our potential customers, among the target audience, in order to attract them to our company and to those particular products. The same way we can do with customers. We can use the low margin operations with the particular customers in order to keep good relationships between our business and the business of our customer. For example, if we want to attract the very big wholesaler or some very important client who can pay us in future, so we may, for example, use 1 or 2 periods with low customer margin in order to let him or her to understand that our business is good enough to be the partner of this particular customer. But of course, I'm telling those examples not because we should do it every time, but as examples of management decisions related to customer margins and product margins. But if you want to make some decisions regarding those indicators, you have to calculate them and you have to understand what is the role of those indicators in management accounting and in business process in total. When we are speaking about activity-based costing system, we may calculate 2 types of margins using specific sequence of steps. For example, product margin calculations could be using several steps. So the first one is computing product margins and gather each product sales and direct cost data. So here we collect together all direct expenses in order to understand what is the product margin. Then we calculate it in details when we use activity-based costing to calculate the overhead value that should be included. When we apply all the costs, so we can calculate the total cost and therefore reduce our sales to the total cost value and calculate the product margin. And you can see on this example that the company has two basic products, Sure Start and Long Lives batteries. I think you remember this example from previous class. And you can see that one product, which is a traditional one, has quite a big margin, equal to $8,000. And the second product, which is not so popular, has the negative margin because expenses are bigger than sales that they bring to the company. And then it's time to decide what to do with this product. Maybe to reduce the volume of output, looking for the real demand on these products, maybe to reduce cost of these products. So when you have some value, you can make several decisions related to the process that lead to this negative performance. But product margin calculations is usually calculated to collect the information about the potential productiveness of each product, about the potential profitability of each product, because you know that product margin is not the net income, because we have to extract some other expenses, like administrative expenses and so on, and our margin will be reduced, and finally our profit, I mean the net income and the real profit after taxes, would be much lower than we can see here in product margin. But the product margin is a very important indicator that allows us to understand the result of the pure production process, disregarding other expenses that are not directly related to the production system. Product margin calculations will also be supported with the net operating income or loss calculation by products and in total. Of course, it's not so effective to calculate it by separate product. Usually companies are calculating net operating loss in total using the full scope of products. But of course, the information regarding the margin is the very important one, and will give to the management lots of facts to think about before they start making decisions. When we speak about customer margins, so it's also very important to calculate the result of relationships with the particular client in order to understand the profitability of operations with a particular client. Let's see this example. And the first step is to gather sales and direct cost data by customers. And for this purpose, firms usually are creating special databases where they collect information by clients, by contracts, by periods, and so on. So it could be done using special CRM systems or manually in Access database or Excel even. If your business is relatively small, you can use something like that. Then, when you have collected sales and direct cost data, the second step is to incorporate computed activity-based cost assignments. So we have to understand how many customer orders, product designs, operations, order size, and customer relations. So how the activity pool is involved into the customer service or into the production process. So when we collect all these indirect expenses, we can calculate the customer margin itself and decide whether the operations with this particular client are profitable or not profitable. And in that case, we have to decide what to do in future. So here we can see that customer margin is calculated and it is positive. So these expenses are fully covered with sales, and therefore the relationships with the particular client are profitable. So as I already told, that we can use even negative margins temporarily, but we have to understand the purpose of these negative margins in order to decide whether this approach is good enough in our state of nature, in our financial position, so whether we can produce so low margin relationships, and maybe we have some plans for the future when our relationships became profitable and we will cover all our previous losses. Or maybe this is a just a specific type of the activity that can't be recovered. For example, if company is deciding to support some community, some special networks, so it may decide that those relationships could be could have the lower margins, and company will support it using the more profitable items that they produce and sell. So actually, these are two types of margins that are used by different companies in order to understand the decomposition of sales and the profitability of different segments related to different products and to different customers. So therefore, we can summarize this ABC costing topic, looking for limitations of activity-based costing method. First of all, activity-based costing use substantial resources that are required to implement and maintain. So we need to collect lots of efforts in order to implement ABC, because we need to train our employees. We need to implement special management rules and methods. We have to purchase special RFID systems to control for the inventory and costs. So we have to involve lots of resources to implement and maintain this system. It's resistant to unfamiliar numbers and reports. So ABC costing system is focused on the specified values and information. So some unexpected issues are not included. ABC is desiring to fully allocate all costs to products. So the idea is good enough, but if our expenses, for example, administrative expenses, are not reasonable, we allocate those expenses to products, and probably due to this fact, our products would have the lower profit in our profit and loss statement, and therefore the reason of it would be not the wrong production system, but the wrong allocation basis that is selected. So ABC had the potential misinterpretation and unfamiliar numbers. So if, for example, something is going wrong, so it would be difficult to interpret the results of the operations. So, for example, if you have collected the full cost, looking for specific activity cost pools and activity measures, if your measures are strictly different from planned values, it could be difficult to understand why. And it doesn't conform to GAAP or Russian standards of accounting, so two costing systems may be needed, and this is the limitation, of course, because companies would involve more employees, and those employees would have a high education level in order to understand all ABC costing system issues. But today, this limitation is not so sufficient when we have the artificial intelligence and lots of accounting programs that will summarize information using different bases. And if your company is looking forward, it could develop a special design for the company that will allow to collect information quite fast without any additional labor resources. But of course, some resources will be needed, and the cost of this development is also very sufficient. So to develop the individual module for management accounting is not very cheap. So I think it's shortly all about the ABC costing. So whether you have any questions about this method. So I hope you have read this theoretical reading that I have posted to the Smart LMS system. I suppose after this chapter you will have more information to think about, and you will be quite well operating with these terms, definitions, and calculations even. So if you have no questions, we can move to the topic, which is the next one. Just a second, let me check. Okay. And here we will be speaking about normative costing. So what is the normative costing and how to use this normative costing in business, and how this normative costing is related to budgeting, and how we can apply this budgeting system, having the previous knowledge regarding the costing systems and different indicators that are measuring the effectiveness of the system of production. So here we have to move to our second objective. So we have to discuss budgets to provide the medium-term decisions into actionable short-term plans. So budgets are special instruments that will help us to create short-term plans and make those plans related to the strategy of the company. So starting from this very moment, we are very close to decision making and evaluating initial outcomes. So what are objectives of budgeting? Cost accounting for decision and control will give you the specific information regarding budgets of different levels, and you will distinguish between different rationales for budgeting. Then we will explain forecasting and its relationships with budgeting, and describe the process of budgeting and how the budgetary control system provides feedback and feed forward to the organization. So first of all, we have to define budgeting. So the budgeting is the process that will create the budget itself. And the budgeting system is a specialized tool which enables to create a budget structure and effective financial management in any company. So budgeting system is the basis of a good financing management system if we want to have our business developed, so we have to create budgets of different levels and involve them into the planning process. So budget itself is an instrument, actually it's a document that management use as an aid in the planning, programming, and control of business activities. There are two basic approaches to create the budget. First approach is the top-down approach, when goals are developed by the top management, and then they are pushed down from top management to lower levels, and each department creates the part of the budget that is fully based on those top management goals. So top-down approach means the use of the usual hierarchy and the use of common companies' aims and goals in order to make plans for every department. So how do you think, what are negative features of this approach? Why not all companies could use a top-down approach?
Maybe lack of information from top management.
Unfortunately, I can't hear you. Could you start one more time?
Yes, well, I suppose maybe the fact that top management might not have the relevant information to do that. That's why we use the bottom up, or maybe I'm wrong.
Unfortunately, it's not so clear. So I think technical issues will disturb your voice. Actually, the only negative approach, negative outcome here, not the only, but the most important negative outcome here is that top management can create plans that are not realizable by lower level of operations. For example, they may create special indicators, for example, key performance indicators for sales department, for example, to sell, I don't know, 100 items per day, for example. But when those plans would be given to the sales department, they would realize that their usual sales are not so high, and even if they will involve all the resources they have, they can't reach this amount. And finally, they understand that this goal is not realizable and start working with lower motivation. And of course, this approach is not very good. But of course, many companies are using the top-down approach, and they, first of all, create some meetings with the departments. They collect different votes in order to understand whether our plans are realizable. They analyze historical data. And finally, companies that are using the top-down approach find out that this method has lots of advantages. The first advantage is that the goals are really very well associated with the company's strategy. Secondly, all the departments, if all the departments are involved in the discussion of the common strategy, they know each other better and could communicate on a higher level, and that's why those budgets may be realized faster than using the usual approach. So some advantages could be found even there. The bottom-up approach has a bit different option. It's the opposite. sequence of steps when lower level managers are the primary source of information used in setting the budget. So they collect the department goals, the department KPIs, and then move them to the upper level in order to summarize into the company's budget. And the high level management decided to implement this budget and make it closer to company's mission and values and the company's objectives. So this approach is good enough because it is using the information from the lower levels where people are working with the products, clients, and many important parts of the business process. They are involved into the process of production and service, and they know better the production area and the service area and could know exactly which budget is realizable but which is not, and which KPI is sufficient and which is not. But the disadvantage of this method is that sometimes lower level managers could especially decrease the KPIs, so they include into the budget the lower KPIs than they can achieve in order to overcome them in future and get special bonuses for this excess of the sales, excess of the economy of the resources, and so on. So you can see that two basic approaches are used, and they used approximately equally. So we can't say that many companies are using top-down approach, but a bottom-up approach is very rare event. Not many companies are using a bottom-up approach as well. So both instruments are good if they are implemented correctly. Budgets using both approaches are usually prepared for departments, divisions, and for the company in the whole. The group that is responsible for approval of the various budgets is the budget committee. Actually, the budget committee will include different persons in different positions, but actually it includes managers, presidents, CFO, and various vice presidents and controllers. So budget committee is a special team which helps to create, consolidate budget information and approve by different departments and different important persons. For example, even shareholders if they are involved into the management system. So the functions of budgeting are summarized as following. First of all, it helps in making a calculated attempt into knowing what the future holds. So this function is named as forecasting. It uses the forecast that has been made in the past to make decisions about the future. So budget is analyzing the previous forecast and the actual outcome of the business process and calculate the differences between planned and actual in order to make decisions about the future. So this function of budget is named planning. Budget could help to collect the information about the company and the activities of its competitors during the process of making all kinds of budget. So this function is a monitoring. So every company during the budgeting process should monitor the environment and competition around the company in order to satisfy the needs of the market and in order to be in trends and to look forward in understanding how to get some competitive advantage before the other companies. So this monitoring function is also very important. It is the driving force that makes people to run toward the goals. So budget is realizing the function of motivation. So the budget could motivate people to overcome the goals, to produce and sell more, to achieve bigger and more sufficient results. The budget represents the target performance which will be compared with actual performance. So budget is realizing the function of evaluation. So evaluation is a very important part of the budgeting process. And budgeting helps to minimize misappropriation and embezzlement. So we have to speak here about control and authorization. It's very important to have the budget authorized and signed by all the people that could realize then this document and make these values real products and real profits of the business. So these are 6 basic functions of budget. So how managements are working with the budget? First of all, they use all these steps as planning, organizing, controlling, and evaluating for decision making. While they are making this process, they initiate plans, implement those plans, then measure performance. So what happened if those plans became the reality, and evaluate the performance. Is this outcome the same that we plan to have or not? And if not, what should be changed in future? Therefore, initiate plans and implement plans will give us the full planning system that involves developing objectives and preparing various budgets to achieve these objectives. So budgeting is helping to realize the planning function. When we speak about budgeting, we always keep in mind the budgeting period. So it's also very important. The length of time covered by a budget is usually called the budget period, and it is usually equal to 1 year. It could be, of course, a bit bigger or a bit smaller if it is necessary. So some companies are preparing the quarterly budgets. And they do not simply split the budget between different quarters, but really create a fresh budget each quarter. But these approaches are not very common. Actually, budgeting period is 1 year, and annual budget is used to compare current financial performance with budget plans. And annual budget is normally prepared for a company's fiscal year. So our fiscal year should be the same as the budgeting year. So for better understanding the final performance, to get the adjustments be made before the check between actual and budget values and so on. So the first issue is the basic budgeting period is 1 year, and the second, our budgeting period should be comprised with the fiscal year. If our fiscal year starts at the 1st of December, our budgeting period should start at the same time. As we have in Russia, the financial year starting from the 1st of January, so budgeting period starts the 1st of January as well. I think this approach is quite simple and logic. So to choose the budget period, we may use special definitions. We would have operating budgets. Operating budgets usually cover a 1-year period that corresponds to a company's fiscal year. Many companies divide their annual budgets into 4 quarters, and some companies that are quite big divide their quarterly budgets between months that are included into the quarter. But all these budgets are related to each other, and they are operating budgets because their goals are fixed for the period of 1 year. The second timing for the budget is the continuous budget. A continuous budget is also a 12-month budget, but not a simple one. Starts at the 1st of January and ends at the 31st of December, but it is rolling forward 1 month. For example, continuous budget will start at the 1st of January, but at 1st of February it will be rolling forward 1 month, and our new budget period starts at the 1st of February till 31st of January. So rolling budget means that this process never stopped. So which companies are using this rolling budget? Actually, companies that use massive production, companies that are using project, not operating, but the project oriented business model. It means that they have no concrete production process that is stable within the periods, but project-oriented companies are using projects instead of process, and they implement projects and close the projects, and after that calculate the profitability of each project. And for budgeting, those companies may use their rolling budget because projects would have different lengths, different sums to realize different costs, and therefore for them it could be quite convenient to use their rolling budget. So rolling budget is very similar to the moving average calculation. So when we every time move our calculation period one level down, and the same we will do for the rolling budget. Advantages of budgeting could be listed as first of all, we think about plans for the future. So it's very important even for small business, because very often small businesses are not thinking about budgeting. But as we realized with the previous groups that were under my supervision in previous year, they have made some projects related to budgeting systems and interviewed the owners of small companies that whether they are using or not the budgeting system in their businesses. So 90% of the small entrepreneurs are not using budgets at all, but 10% do. And they said that it's a good idea to think about plans for the future, because a budget is a detailed plan actually that would help you to understand not how could you produce and sell your items, but whether this production is or would be profitable enough. And maybe at the first moment of realization, you can see that it is not a profitable direction of business, or it is not profitable product, and that's why you can make the changes before you start, before you are involved into those very costly experiments. So it's good time to think about your future and your plans about your business while you are developing the budget. First of all, means of allocating resources are listed. So when you are creating budgets, you are better and you have better understanding of your resources, where to take them and how to implement. So you can realize what are means of allocating resources, what systems are involved, what indicators are calculated, and so on. Therefore, it gives us the next benefit to uncover potential bottlenecks. So, for example, in previous practical session, we had a question about the limiting factor. So here we can uncover those limiting factors before the production is started, before we purchase the extra material resources without the balancing those resources with labor and equipment, for example. So potential bottlenecks could be defined at each stage of production, and before the process begins, you can do some actions to prevent those bottlenecks. So then, next advantage is that you can coordinate activities of the departments of different level specialists to make the production and service process better and well coordinated, and therefore I think it will increase the profitability of the business. Then budget require communication between different persons and departments. Therefore, the advantage of budgeting is the communication plan. So budget require the involvement of all level specialists in order to understand whether the business is good enough to continue it and to gain profit from the process. And the last one is that budget could help to the company to define its goals and objectives, because sometimes production is going on, but people do not think about the future, and finally they may face the situation when those products are not very modern and the demand is decreasing, but they didn't do something with the goals and objectives and continue production the same products. So budgeting would give them the opportunity to look forward and to think about the production process in details. Then we will speak about different approaches in budgeting from the historical perspective. We will speak about zero-based and master budgets. So to prepare the budget, we need to make some necessary steps. First of all, we formulate a budget committee, which will take up the job of budget preparation. So this budget committee will start the process of budgeting just before the year end. So actually they start preparing the budget just after the current budget was signed and taken into use. The budget committee will create standard budget forms of which production plans, estimated income and cost may be inserted for each section of department of the business concern. So they create special documents, forms, and think about the content of those documents. Then committee asks accounting department to submit reports for the past year showing comparison of production cost, income and expenses by subdivisions and departments. So they collect information from financial area in order to understand whether the previous budgets were implemented correctly and what are the differences between actual and budget values and what are reasons of those differences, because it's very important. So each functional executive is asked to prepare and submit the forecast for his department. For example, the Department of Logistics is preparing a special report regarding the delivery systems, warehouse storage, and repack of products. and their forecast should be related to the production department forecast, because they may forecast the shipping cost only when they know what product they plan to produce and sell and to what countries, or maybe what destinations within the country. In consultation with functional or departmental executive, the budget committee reduces general policies of the concern to department plans. Actual departmental budgets are prepared, revised, and formats of standard performance for the budget period. So actually later the budget committee is summarizing all the forecasts given by different departments. They decide to sum up them and speak about each department head in order to make those plans just consolidated, and after that each department head would take the responsibility for the departmental budget, and the budget is signed and the work starts. So when we prepare the budget, we may use two different types of preparation. So the common approach is that we are using the budget for the previous period in order to correct it a bit and approve as a new year budget. But there is one more assumption. It is the zero-based budgeting, which every time starts from zero, from a clean slate. Zero-based budgeting is really good enough for non-profit organizations. So they are mostly use zero-based budgeting because they start new year with the new slots, and that's why they are using this system. If the company is using the project-oriented operation system, they also may be interested in zero-based budgeting. For example, if you are the studio that is producing movies, you may be interested in zero-based budgeting because a new year for you starts with new projects, new films or cartoons, and historical information gives nothing to your current project. That's why zero-based budgeting is good enough for several basic types of organizations. The usual business approach is to prepare the budget based on prior information, and this is a master budget approach. So the master budget is a comprehensive planning document that incorporates a number of individual budgets related to special parts of the production process. The master budget is just the aggregation of all lower level budgets produced by companies' various functional areas. So at the right, you can see the list of those that may be included into the master budget. So we can see different budgets that companies are using as a basis of planning. So the master budget is based on various estimates and assumptions, of course, because we never know what our future would be in details, but sometimes we are right and sometimes are not. For example, the sales budget requires pre-estimates. For example, what are the budgeted unit sales? What is the budgeted selling price per unit? And what percentage of accounts receivable will be collected in the current and subsequent periods? So those estimates are the basis of the budgeting system, and each level is using the specific assumptions, and therefore, of course, our budget is only the plan, but not the issue that is unchangeable at all. And you can see how many divisions could be in this document. How those subsequent documents are related. So where to start if you decide to produce a budget? So first of all, if you have any questions, you can use the chat to ask them if something is not clear. So don't forget about this. So where to start if we are speaking about budgeting? We always start with the sales budget. So actually the basis of the budgeting system is the sales budget. After that, we plan together production budget and selling and administrative budget. So these are budgets of the same level. Then we produce ending inventory budget, which is really related to sales and production. Then the lower level budget is related to direct materials budget, direct labor budget, and manufacturing overhead budget. And these three budgets are summarized together to prepare the cash budget. And you can see the connections between sales budget and cash budget because it's important. If we make sales, we have money to pay for materials and labor. And the last step of budgeting is to prepare the budgeted income statement and budgeted balance sheet. So this is the lowest level of the budgeting system that require all previous steps to be ready. So I think it's clear how those budgets are related in the master budget. To prevent misunderstanding between different budgets approach, I'd like to say that the master budget could be made using the bottom-up approach and the top-down approach. Anyway, relationship between different types of budgets are the same under all these methods. So the master budget could be prepared using the bottom-up approach and the top-down approach. So those are not contradictory issues, but they are just supportive issues. Budget relationships, analysis, and control. So how to perform those relationships between different budgets and how to use values to control for the process. We start from the sales budget that is related to production budget. So the sales budget comes first because other budgets cannot be prepared without an estimate of sales. So if we decide to sell less, we have the lower plans for production, we have lower plans for selling efforts and administrative expenses and so on and so forth. For example, production estimates are based on forecast sales, so we have to understand the product mix that we plan to sell, and therefore we decide the product mix we plan to produce. Then companies use a variety of methods to estimate sales. For example, they may use econometric models, sales trends, trade journals and magazines, and sales force estimates. You may also make a survey within your customers in order to understand whether they plan to increase the volume of purchase from your business or not. You may make the survey among the potential customers and make some efforts to attract new customers, and therefore this information is useful to predict the sales budget. When you have done this, you make the production forecast, so you are looking for your inventory and decide how many units you need to produce in order to fulfill the sales budget. To avoid the situation, this action is needed to avoid the situation when the demand is high, but you have no products at your warehouse to sell. So this is a real bottleneck, and to prevent it, you have to make special schedule of production, which should be splitted between production periods. For example, a year may be splitted between months, weeks, and days of production in order to understand how many items should be produced each day to fulfill the customer's needs. So finished units to be produced is calculated as expected sales plus desired end inventory minus beginning inventory of finished units that you already have at your warehouse. Let's see how it works in reality. Royal Company is preparing budgets for the quarter ending June 30th. And here you can see budgeted sales for the next 5 months and the selling price, which is fixed at the level of $10 per unit. We use those values to create the budgeted sales in units and to calculate the total budgeted sales in dollars. So you see that the company is using the same price for all the periods and for the quarter. So they split their budgeted sales between months and quarters. So as sales are prepared, we have to decide what is the payment pattern, because it's also very important. For example, Royal's collection pattern is 70% collected in the month of sales and 30% is collected in the months following sales. Therefore, they have some receivable balance at the beginning of the period, and they have to use these values to create the expected cash collections. So, to create the expected cash collections, we use the account receivable information at the beginning of the period. Then you split your every month's sales to 2 parts, to 70% that have to be collected this period and to 30% that have to be collected next period. Then you may do with all the months the same work. So you split then May sales between on account sales and the actual sales for cash. And of course, put those values on correct places. So the question is, what will be the total cash collections for the quarter if we are looking for this data? So if we go back, we can see that they plan to make 200,000 in April, 500,000 in May, in June, 300,000. It should be budgeted sales, and 1 million for the quarter in total. But what would be the cash collections for the quarter? So what is your version? So for those who decided to calculate, I may tell that this would be 940,000 because some volume will be sold on account, then we'll receive it only next quarter. So when we calculate this, we know that some amount will be left for the next period, and therefore our actual sales are not equal to our cash collections. So when our sales budgets are prepared and expected cash collections are calculated, you have to make the production budget. The production budget must be adequate to meet budget sales and provide for desired ending inventory. After that, you can calculate the required amount of materials and go further with the budgeting process. So the next step is to prepare the production budget. If we will be speaking about the same examples, with the Royal Company. So if they want to have the ending inventory to be equal to 20% of the following month's budgeted sales in units, and on March 31st they had 4,000 units on hand, so we can prepare the production budget. So our budgeted sales are the same in units, and we have to add the desired ending inventory and calculate the total needs of the company for the current month. For example, if budgeted sales are equal to 20,000 items and we have the desired ending inventory equal to 10,000 items, because they should be equal to to 20% of the following month's budgeted sales in units, and we have in May to sell 50,000, so 20% is 10,000 units. Then total needs is equal to 30,000, and beginning inventory was 4,000, and required production is total needs less beginning inventory. Therefore, it's equal to 26,000 items. So let's calculate the desired production for May. If you will see the calculations here, you know that this production would be equal to 46,000 units, because we need to take into account our budgeted sales volume, desired ending inventory, that is 20% of the following month's sales, then we should take into account with the beginning inventory we have from the prior period. So the same process will go further, and when we start to prepare the same for the quarter, it's not just an arithmetic sum of 3 months. It's a separate calculation for the quarter, because the beginning inventory of the quarter is the beginning inventory listed at the 1st of April, and the ending inventory for the quarter is the ending inventory listed in June. That's why your quarter information is not just the sum of all the indicators for prior months. It's a special calculation for the quarter. Don't forget about this. When your budgets are ready, I mean sales budget, cash collection budget, and production budget, you may go further and develop the direct material purchase budget and direct labor budget. The direct material purchase budget require the amount of direct materials that must be purchased that is depends on amount needed for production. So your production budget is the basis for the direct material and labor purchase budgets. So here you can see the formula, how these conversion may be made. And let's see how it is really made in our example. If the Royal Company uses 5 pounds of materials per unit of production, per unit of product, management wants materials on hand at the end of each month equal to 10% of the following month's production, and material cost is equal to 0.40 per pound. So we have to prepare the direct materials budget, and we start with the production volume that we can take from the production budget. Then we calculate the number of units, for example, pounds needed for each unit, and multiply, calculating the production needs. Again, we add here the desired ending inventory and calculate the total needs, and extract from the previous volume the beginning inventory, and finally we will know how many materials should be purchased at the end of the period, for the period. So these values are providing us with the information we need in order to understand what materials should be purchased and in what quantity, and how much materials should be purchased in May. So have you I think it's clear that if we will use all these calculations, it's equal to 221,500 pounds, because we use the information about the required production in these months, materials per unit that planned to be used, desired ending inventory, and beginning inventory of the prior period. So materials to be purchased is equal to this very amount. We continue working with this direct material budget, and finally we will do the same for the total quarter, but not arithmetically summarizing the values from the prior periods, but calculating the quarter information as from the beginning of the quarter till the end of this period. Then we move to the direct labor budget. Using this new information, let's try to understand how this process is organized. So we use a number of units from production budget. Then we use this normative for direct labor time per unit, and we will get the labor hours required. Then we use the hourly wage rate to calculate total direct labor cost for the period. And then we can move to the manufacturing overhead budget and budgeted income statements and the balance sheets. So manufacturing overhead could be calculated using the predetermined overhead rates from the previous period that could be somehow revised for the current period, using the historical data and using the new information regarding the number of products that is planned to produce and sell, and using the specific information regarding the current period. For example, if you decide to cut administrative costs because you decided to implement the RFID system, for example, it will be reflected in the predetermined overhead rate. if you decided to replace the manual labor by the automated equipment, so it should be also reflected in the predetermined manufacturing overhead rate, because now we will use the new basis for the rate calculation. Maybe not the direct labor hours, but machine hours, in order to make the overhead over applied or under applied with the smallest difference between actual and applied values. Then when your production budget, sales budget, direct materials purchase budget are made, you can make the income statement, calculate the cost of goods sold, and prepare the balance sheet. So this is an example how this firm Royal is making the overhead budget. You can see here they use the manufacturing overhead rate and decided that the cost driver is the direct labor hour. And they also have the fixed manufacturing overhead value. That includes the 20,000 of non-cash costs, so depreciation of plant assets. And overhead budget, therefore, will be calculated as direct labor hours taken from the labor budget should be multiplied by variable manufacturing overhead rate so it should be also added fixed manufacturing overhead cost, and we can calculate total manufacturing overhead for quarter and divide it by the total labor hour required and calculate the rate for per hour. This rate is a bit rounded, so we can use it for the period. Later, we will use the non-cash costs in order to calculate the cash disbursement for manufacturing overhead. So we need to calculate how much cash could be supporting the production process from the manufacturing overhead side. Then we prepare the finished goods inventory budget. We use quantity of materials from the direct materials budget and information. Then we use direct labor that we need to create the unit. Then we use the manufacturing overhead rate per the labor hour required. And finally, we calculate the unit product cost and ending finished goods inventory in dollars, because we know how many units we have on our warehouse at the end of the period, and we calculated the unit product cost in order to understand what would be the ending finished goods inventory when we complete all the budgets. So this ending inventory is taken from the production budget. Our next budgets are related to capital acquisition budget and cash receipts and disbursement budget. So, but we can see it in details, I think, next time, because it's not so simple process to prepare this cash disbursement budget, and we may discuss all other important questions. And meanwhile, I want to ask you, what are your today's questions, whether the material is clear enough or not, and how can we make this material more clear to you. So your questions, please. So is it clear if we sum up all the mentioned above? that the budgeting system is a very specific area of activity of each financial department within the organization. If we will be speaking about persons who are responsible for budgeting, I may say that every company has special person which is responsible only for budget process and budget analysis. Actually, he or she is the budget committee secretary or special accountant, which is responsible for planning and for the future forecasts and collects information from different departments to sum it up and prepare the budget. So this person is involved into the budget process within the full year. When the current budget is applied, she or he immediately starts preparing budget for the next year. If the company is using the rolling budget, this person is responsible for recalculation of budget values every period we will use for this rolling system. So when January is almost over, she or he is introducing the new rolling yearly budget that starts from February. So this is a very I think very comprehensive work, and people that are involved are usually really busy with other functions, and it's not a very easy process to collect them together and discuss future when our current routine activity is involving persons in current activities, but not in discussion regarding the future outcomes. So to work with the budget is not a very simple task for everyone, but this is a good source of information because the budgeting process will give you the information about the full business in total, about the every detail of the business and how it is related to the current situation or outside of the firm. So if you want to learn the process of production and selling and connection between departments in total, you have to join the budgeting department for your practice, for your trainings, and it would give you lots of information about the business model of the company. Okay, if there is no questions, so thank you very much for coming. I think other persons would see this presentation in recording. Thank you very much for your efforts. See you on practical sessions, and goodbye.
Goodbye.
See you.
Bye. Goodbye.